Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to begin a new topic on interpretation of financial statements. We are going to learn how to interpret the financial statement that has been prepared by the accountant. And then we are going to begin by learning accounting ratios. The ratios that are supposed to be used as a guide to help us in interpreting this financial statement. Okay, remember that we have said that accounting has to do with recording of the transactions and then summarizing them into financial statements and then interpreting them to the users so that they can make informed decisions. So this is where we are going to do the interpretation, and one of the major interpretation tools that we are going to use is the ratio analysis. We are going to calculate accounting ratios. This topic is relevant for financial reporting, financial accounting, and also for financial management as well. And so I want you to pay attention because you are going to need it even in corporate reporting, and then it's going to help you very much. It's going to cut across almost every business program that you are doing, both at the academic and the professional front. A very important topic that does not miss in any exam that is relating to financial reporting or corporate reporting. Please pay attention very well. Okay, like I said, we are going to use the accounting ratios as our main tool for interpretation, and that is what we are going to focus on for now. We are going to look at the categories of the ratios, the types that we have, and then we are going to look at how to calculate them. What I mean is that we are going to look at the formulas of these ratios, and then we are going to, as we understand the formulas, we are going to learn also how to make interpretations with these formulas. Okay, and so we are going to deal with accounting ratios. With the accounting ratios, we are going to look at the categories of the ratios. Okay, we have 5 different breakdown of the ratios in terms of the categorization. So we can call the first one as profitability ratios. And then we have liquidity ratios. I'm going to explain each of them. And then we have the activity or efficiency ratios. And then also gearing ratios, gearing or leverage ratios. And then we have the shareholder investment ratios. These are 5 categories of ratios that we are going to look at. We are going to look at the profitability ratios, liquidity, efficiency, gearing, and then the investment ratios. Now, take note that each of these categories have special focus, or yes, special focus of interpretation. The profitability ratios deal with issues about profitability. Okay, so we are going to use the profitability ratios to interpret the profitability and the financial performance of the business as far as profitability is concerned. Okay, and then we have the liquidity ratios. Liquidity looks at working capital issues, related issues. And so we are going to look at that as well. There are some ratios. So under profitability, there are some ratios that we are going to calculate under that. And I'm going to show you the formulas for that. When we get to liquidity, we are going to look at formulas for different kinds of ratios under the liquidity. And then we are also going to look at the efficiency ratios. Now, most of the activity or efficiency ratios are also related to liquidity. Okay, so we are going to look at that also separately, but in a way, we analyze them together with our liquidity issues. So we are going to also look at that. And then we have the gearing. The gearing has to do with the debt component of our capital structure. And so mostly, we are going to look at the debt levels. Okay, how geared are we in terms of debt? And then we are going to calculate ratios on that and interpret them. And then finally, we are going to look at the shareholder investor ratios, where we are going to look at the ratios that are concerning shareholders' investment in terms of performance with the shareholders. whether we are achieving shareholders wealth maximization or we are not doing that. And so these are 5 categories of ratios, which I'm going to take each of them one by one and then try and expand the ratios that are falling under each of them. And then let me also tell you something, that when it comes to this topic, the most important part of the topic is the interpretation. It's not about the calculation of the ratios. As for the ratios, you are going to learn the formulas. Okay, you can get the formulas, you calculate them. The higher you go in terms of the accounting or finance, the higher is expected of you from the interpretation aspect. When you are at the lower levels, your lecturer or the examiner may pay much attention to calculations with little focus on the comments, even though it's still important to interpret. So at that level, what you normally do is that, for example, with the professional exam, if you are writing the level 1 of the CA or ACCA or whatever, you see that most of the time you'll be asked to calculate the ratios, and then you also be asked to make comments on the ratios. So your comments are going to be the interpretation. Okay, so you just calculate and make some comments under. But when you get to the level 2 upwards, or when you get to the master's level in academia, or even at the higher level of the first degree, most of the time they do not want you to just make comments under the ratios. What you are going to do is to actually write a report interpreting the ratios that you have calculated. Okay, so as you move higher, the focus is mostly on the reports writing. You can even get to the level, especially in the final level of the ICAG professional program in Ghana and the ACCA, you realize that sometimes the ratios would have been calculated for you already in the question, and that what you are supposed to do is just to write a report interpreting the ratios that has already been calculated for you. And so yes, you need to understand how to calculate the ratios. But this topic, like I said, I am treating it for all levels at a go. So I'm going to show how to calculate the ratios. I'm going to show you how to make comments, and I'm also going to show you how to write the report, so that for whichever level that you are using this is going to benefit you. And then mind you that this topic will come across. At the level 1, it will be there. At the level 2, it will be there. At the final level, it will be there. Because one of the main functions of accounting and finance is to interpret financial statements to the users. And so just pay attention as I take you through these ratios one by one. And then I'm going to first of all show you how to calculate. And then we are going to also learn how to interpret them. Okay. And so we are going to begin with the profitability ratios. Now, when we look at the profitability ratios, our concern, now we have so many ratios that we can calculate under the profitability, but I'm just going to be concerned with the main 3 that we are going to meet, and I'm going to focus on that. And so when we get to profitability ratio, the first one I can talk about is your net profit margin, or what some others may call the net profit percentage. Now, the formula for calculating the net profit margin is your net profit over your sales revenue, or your turnover, times 100. That is if you are getting it in percentage. Now take note, net profit over sales times 100. The sales here is total sales. Now when it comes to the net profit, for a company account, we could have net profits before interest and tax. We have net profit before tax and net profit after tax. So usually we use the net profit after tax to calculate this ratio. And now one thing I want you to understand is that when you are looking at ratio analysis, they are going to give you what we call industry average. Now there are 2 ways to look at accounting ratios interpretation, because if you are an accountant and you're supposed to write a report on your financial performance and position, okay, there should always be a benchmark that you are using to compare to see whether you are doing well or not. And these are the 2 ways. It's either you are going to be given, or you are going to use previous year's financial statement as a comparison to interpret. It's either you are going to use previous year's financial statement to compare and then look at your performance. So maybe you are calculating the ratio for 2020, you calculate for 2019 performance, and then you calculate for 2018, and then you compare through the years which ones you are doing better in terms of profitability, and then you make a comment. Now sometimes it will not be just the previous year's financial statement, it will be a comparison with the industry average. Remember that the company belongs to an industry and you are competing in an industry, and in that industry your competitors are also performing. Now if you take the average net profit margin of the industry, okay, if your industry performance is on average of 20% and you are doing 22% profit, then you are performing better than the industry average. But if the industry is doing, let's say, 18% and then you are doing, let's say, 15%, then you are performing below the industry. Okay, so in the exam, it's either you'll be given 2 or 3 different years financial statements, or you'll be given an industry average as a comparison measure, or you can even be given both together. And that is going to make your analysis very complex, because you would have to look at the industry and talk about it, and then you also have to look at your internal performance over the years and then you talk about it, and then you look at the two of them, and then you can try and blend to conclude on your profitability. And so we are going to look at the net profit margin, your net profit over sales times 100. So the question is supposed to give you an already prepared financial statement or some list of figures that is going to help you, and you are going to find your net profit in there. And I have told you that we are going to use the net profit after tax. However, if they have given you an industry average, and what they use to calculate the industry average is, let's say, net profit before tax, then you have to use the net profit before tax. What I mean is that whether after tax or before tax, when you are measuring performance, your standard of measurement should be the same as the standard of the industry. That is what you are going to use. But normally we use the net profit after tax. And so if you have, let's say, net profit of $200 and then sales revenue of $2,000 within the year, then if you multiply this by 100, it means that you are getting 10% profit. So this is the interpretation, and that is what I'm mostly focused on. I'm not focused on just the calculation, I'm focused on the interpretation. The interpretation is that you were able to make 10% net profit on your sales. That is the meaning. You are supposed to, you were able to make 10% profit on your sales. Now there are times that when they are giving you the industry average, it may not be in percentage. That means that they didn't multiply by 100. So this is just going to be 0.1. So whether you see 0.1 or 10% is the same thing. Okay, and what I want you to understand is that this ratio actually means that you are making 10% profit on your sales revenue. So for every sale you make, 10% ends up as your net profit. And we know net profit is the final profit. So you would have already taken out all your direct and indirect expenses, and you have arrived as a take-home profit of 10% on sales. And so if the industry is doing, let's say, 15% as net profit margin, then you have a cause to complain, because your industry is performing better than you. And that means that you are not doing well. And so you have to mention that in your comment, or you have to mention that in your report that you are writing on your financial performance as an accountant. Now take note of something, that you cannot just mention, because in the reports that you are writing, after this I'll teach how to write the report. But in the reports that you are writing, you cannot just mention that oh, we had 10% sales and it's less than the industry, so the company is not doing well. That is not enough. You are expected to look at the financial statement and mention possible areas which you think the company should look at, which relates to this kind of profitability and which is causing the downfall of the profits. So for example, if let's say it's not an industry comparison that you are doing, but you are doing an entire comparison, and in 2019 your net profit was 20% net profit margin, and then in 2020 your net profit has declined to 15%. You have to compare the two financial statements. Perhaps the sales figure up here was much more bigger than this, or it could even be that the expenditure or the indirect expense in 2020 is higher, because the more the expense, the less the profit. And so if the expense is also higher, it could also result. So you have to study the financial statement and then understand and then make a comment that, okay, this is because in 2020 there was more expenditure in this area and that area. Or it could be that if the reason is a reduction in sales, for example, you can also mention that they need to maybe increase their sales by maybe boosting advertisement and all that. So you need to be a business minded person when you are tackling this type of question, because sometimes marketing related issues will come in. You have to mention advertisement, you have to mention sales promotion when it's necessary, especially when you realize that there is a decline in sales that is causing the profits to fall. So you have to mention all of that in your report or in your comments that you are making. Okay, so this is about the profitability. So this is the net profit margin, 10%. I'm not done with profitability. I'm going to add two more formulas, and then we are going to analyze them together and understand how to present our analysis on profitability. Okay, now the next formula under profitability, or the next item, is your gross profit margin, which they also call gross profit percentage. And the formula is very similar. Just like this is net profit over sales, this one becomes your gross profit over your sales revenue. That is a total sales times 100. So you get that also in a percentage. Okay, so gross profit margin is your gross profit over sales times 100. Net profit margin is your net profit over sales times 100. A very simple formula. Like I told you, the formulas are not difficult to memorize, but the interpretation is the most important thing. So, yes, it is just like the net profit margin. However, the gross profit margin is expected to be bigger than the net profit margin, because with gross profit, you have only deducted the direct expenses and you have not taken out the indirect expenses. And so let's assume that you have your gross profit margin to be 40% and then your net profit margin to be 10%. Let's just assume. Now, what it means is that the extra 30% that has gone off is as a result of your expenses, indirect expenses. Okay, let's assume that the industry in which you are working, we are doing industry comparison. I'll come to the inter-year too. So if your industry has a gross profit margin of 35%, let's assume, then it means that you are doing well than your competitors when it comes to gross profit. But let's assume that the same industry has a net profit margin of 25% as the average. So you are doing well in terms of gross profit, but when it comes to the net profit, you are doing very poor when it comes to the net profit margin. Then what should be your interpretation? Okay, it's not enough saying that they are not doing well. No, that is not what the examiner is expecting from you. The examiner is expecting you to go beyond and look at the possible reasons, and then maybe, if possible, suggest what to do to the company, because mostly the report is for the board to sit and deliberate on the report of the accountant. And so what you have to do is that, yes, we are doing well in terms of gross profit. Net profit has declined. As compared to the industry average, we are not doing very well. The difference between the industry is 10%, meaning that 10% of the sales expenditure, meaning that the industry average is that only 10% of sales is used as indirect expenditure. But we are using 30% of sales as indirect expenditure. So what should be your advice? We should cut down some unnecessary expenses. That should be the advice in your report. So you have to make mention of some unnecessary expenses that is being incurred. Or even if they are necessary, they should look at it again and then maybe try and then cut down some expenditures. If not, we are not going to be able to compete in terms of profitability. Okay, so this is generally what it means. Now, if you are talking about inter-year comparison, it becomes easier, especially when it's your own financial statement, 2018, 2019, and 2020. You have calculated ratios for the three, and you are looking at the trend. You just compare. And those ones, what makes it more technical is that you have different financial statements. So you can look at them, and then you can see whether sales was actually bigger, whether the expense was actually more than the previous year and all that. And then you make your comments on that. We'll get to report writing also, and we are going to solve questions. And so please just follow me on this. Now, the final one when it comes to the profitability is your return on capital employed. I'm not saying this is a final ratio. There are other ratios of profitability. But for what I'm doing with you today, returns on capital employed, which is one of the most important ratios. And the formula for returns on capital employed is still your net profit over capital employed times 100. Now, this is where the issue comes in. I've told you this net profit should be after tax. Now, this capital employed becomes a very tough item to fish out for a lot of students. What does it mean when we say capital employed? Because you look on a financial statement, and if you are not careful, you are not going to see anything like capital employed, especially when the statement of financial position was prepared based on the total assets style. So you have total assets, you have equity and liabilities. How do you get your capital employed? And take note, this is how to get a capital employed. I'm going to use the accounting equation. We know that the asset equals to equity plus liability. Now, we can expand the asset to be non-current asset plus current asset equals to equity plus long-term liability and current liability. So I have split the liability into two main liabilities that we have, and then the asset has also been split into two. Now, this is the format of the statement of financial position. So once we are able to list our non-current assets, list our current assets, we have the total assets, then we close it off. Then we have equity, which involves the income surplus, the stated capital, and all the share deals and other ones. You list them. Then if they are long-term liabilities, you list, then you have current liabilities. Now, if you want to go by the working capital way, then you have to move the current liability to the other side. Okay? And once it moves to the other side of the equation, it becomes negative. So you are going to have non-current assets plus your current asset minus your current liability. And that will be equal to your equity plus long-term liability. Now, once you have this expression is what we call capital employed. This whole expression, that is your total asset minus your current liability. Total assets minus current liability, or you can say your non-current assets plus working capital becomes what we call capital employed. And so when you are looking for the figure for capital employed, for the sake of calculating this ratio, you need to go by this formula. Now, let me also draw your attention to something. You know, most of the time, the formula is easy to memorize. But how to get the figures from the question to put into the formula becomes a headache for a lot of students. So that is why I'm taking my time to explain to you that this non-current asset plus current asset minus current liability is what we call the capital employed. Now, let me also blow your mind on something. Have you realized that it is separated, these two sides are separated by an equal sign? It means that equity plus long-term liability can also be called capital employed. Because once there is an equal sign, it means this figure is expected to be the same as the other figure on the other side. So what it means is that if you get a question and you are not seeing this, but you are seeing that, then you have to pick that as your capital employed. And this equity is your shareholders fund. This long-term liability is external debt, long-term debt. And so sometimes you will see in some books that when they are giving you the formula for returns on capital employed, they are not going to say net profit over capital employed. No. You are going to see something like net profit after tax or whatever over shareholders fund, which is equity. Shareholders fund is equity plus long-term debt, which is the long-term liability. So times 100 anyway, if you want to still bring it. Now listen, so it means that it's either you see this way or that way, is the same thing, because the focus is capital employed. And I've told you that the actual capital employed formula that we have is the total asset minus the current liability. But once it is separated by an equal sign in the accounting equation, it means that the other side should be the same as the capital employed. So if you go and in the question you didn't see this, you don't complain that the lecturer has given you a requirement to find the ROCE. The return on capital employed is called ROCE. Okay, the lecturer has given you a requirement to find ROCE, but they didn't provide any figure on total asset and you are confused. You don't know what to do. I have told you it is the same as the equity plus the long-term liability. And that is what we call net profit over shareholders fund and then long-term debt. So it's either you see it this way or you see it that way. Whichever way you see it, returns on capital employed must be calculated correctly. If you get the calculation wrong, then you are doomed, because even though I have told you that the interpretation and the report writing is the most important part of this analysis, however, if you get the calculation wrong, it's going to mislead you in the way you calculate it. Perhaps they will be doing well, but you tell the examiner they are not doing well because you had the calculation wrong. So the calculation is as important as the interpretation, even though I always emphasize that the interpretation is the most important part of this analysis. How do you do correct interpretations if your calculations are wrong? Okay, so these are the three areas of profitability. Now let me also hammer on something, that the meaning of this ratio is that you are looking at, you see, this is your net assets when it comes to total asset minus current liability. So that is what we call the capital employed. So the capital that you have employed in terms of, or let me even look at it from the side of equity and liability. This is the capital you have employed to run the business. How much profit is it giving you? So if you employ the capital of $1,000 and then it is giving you a profit of $500, then this is 50%. Times 100 is going to be 50%. So it means that this capital of 1,000 that you have employed in your business, you are getting a return of 50% on that. So the ratios is like a way of using percentages to analyze our profitability, and then we will understand that better. So you see that interpreting financial statements, especially when it comes to profitability, it's not really about absolute figures. It's about percentages. So if I am making 500 profit, I'm a business, I was giving 1,000 as capital employed, but I brought 500 as profit. That is 50%. If you were giving 10,000, for example, dollars, and then you brought profit of 3,000, this is going to be 30%. Okay, 30%. I am doing better than you. If you look at the absolute profit, you are making more profit. You brought in $3,000 as profit, so you think shareholders should be happy that you are bringing in 3,000, whereas I am bringing in only 500. But that is not the focal point of this analysis. The reason for the analysis is that we are also going to look at how much money was invested into the business. So you put in a capital of 10,000 and it's bringing you 3,000. You put in a capital of 1,000 and it's bringing you 500. Which of the two businesses is doing well? Sorry. Which of the two businesses is doing well? And that is where the percentages come in. So in analysis, we will say this company is doing far better than the other company, not in terms of absolute profit, but in terms of the relative profits, which is the percentages. And so this is all about the profitability ratios. Of course, you could have other ratios that you calculate, but these are the main three. And some of the ratios, as we move on, you will understand that some of them, the names of the ratios itself will show you how to calculate it. Because if I tell you to calculate profit to total assets ratio, then I mean profit over total assets. It's as easy as that. And so these are the profitability ratios, and I've told you that we are going to do the analysis in two contexts, and I'm going to move on to the liquidity ratios. When I'm done with all the ratios in those categories, then we will look at how to solve a question and then interpret them. Okay, so the next category of ratios that we are going to look at is the liquidity ratios. Liquidity. Now, what is liquidity? Liquidity has to do with the ease of converting assets into cash assets, other assets into cash assets. So we are looking at mostly working capital items here. We are looking at the current asset and the current liability relationships over here. Now, let us take note that we know that working capital is your current asset minus your current liability. As a matter of fact, that in itself is a ratio, but we are going to present it in a different way. Current asset minus your current liability. Current asset refers to the short-term resources of a business that are being used in the running of the business to generate revenue. And then the current liabilities has to do with the short-term obligations of the business. Now, this is the expectation. It is always expected that the current assets should be more than the current liabilities. That is what we always expect. Okay, so if I have current assets of $1,000. I expect that these are my resources. This is what I have. I expect that I shouldn't be owing people more than 1,000, because if I owe more than 1,000, where am I going to get the difference to pay? So it's expected that I'm owing less, let's say 600 or even lesser. Okay, now that is what we are going to analyze. We are going to look at the relationship between the current assets and the current liability, and we are going to understand how safe we are in terms of whether we can pay our short-term obligations as and when they fall due, or we cannot pay. If you have more debts than your resources, then you are in trouble. So that is what this liquidity component is going to analyze. And when we are writing the report for analysis eventually after this formulation, we are going to look at the report. You will see that when we get to the liquidity, we have categories. So when we are done with profitability, we come to liquidity, and then we are going to analyze it also. The first ratio that we are going to look at over here is the current ratio. So let me call it ratio number 4, continuing from where we left off. So the current ratio. Now the current ratio simply is a ratio of current assets to current liabilities. So that is your current assets over your current liabilities is to 1. Very, very important. Well, even if you see a formula and then the is to 1 is not there in your mind, it should be there. So you have to bring it. Current assets over current liabilities is to 1. I'm going to teach you the meaning of the is to 1. So now let me quickly list some assets and liabilities here for our analysis. We have, let's assume we have this as our current assets. We have inventory, which is our stock. Inventory to be, let's say, $600. We have receivables to be 800, and let's say we have cash. That is, whether it's cash at bank or cash in hand, cash is cash, to be 600. So when we add, we have current assets of $2,000. Let's also assume we have current liabilities as trade payables. So let's say we have trade payables to be 1,600 Ghana cedis. And let's say that is all about current liabilities. Okay. Now, the current ratio is the ratio of current assets over current liabilities is to 1. Now, looking at this, you will see that the current asset is more than the current liability. We can pay off our short-term debt and even have 400 cedis to spare. So let us try calculating for the current ratio. So for the current ratio, over here we are going to have 2,000 over $1,600 is to 1. Now the is to 1 is a base, and it stands for the current liability. It stands for the current liability. That's the meaning. The is to 1 is actually there for the current liability portion. But then I'm going to interpret to you. Now if you look at this, 2,000 over 1,006, what is going to be the answer? This is going to give us 1.25. Okay, 2,000 over 1,006 is 1.25. Is to 1 as our answer for this ratio. Now take note. This is the meaning. The first one represents the current asset portion. The is to 1 is always there for the current liabilities. Now this is the meaning. It means that this is how you are going to do the interpretation, and watch it. For every $1 you owe, you have $1.25 to pay. That's the meaning. For every 1 Ghana cedi you owe in the short term, you have 1 cedi 25 pesos to pay. That is the meaning. So it means that this is a positive sign that, okay, you can pay your debt. At least you can pay and you still have the 0.25 for every debt as spare. So for every $1 you owe, you have 1 cedi 25 pesos to pay. Is that not nice? Okay. Now let us look at quickly as the next ratio. But before we look at that, listen. It is expected that for every organization, you should be more over 1. When it comes to the current ratio, it should not be less than 1. If you have it less than 1, it means that it will be, let's say, 0.9 is to 1 or 0.8 is to 1. Then it means that you are having less assets than your liabilities. And in accounting, we call it overtrading. over trading. That means your working capital itself is negative. You have more current liabilities than your current assets. So you are working with a negative working capital, and that is over trading. And that you have to talk about it in your analysis. Okay, so it is expected that all the time it should be more than 1. Even if it's 1:1, it means that you can pay off all exactly, but it's still not the best. You should always have some surplus funds on you. Okay, so let me quickly look at the next formula, which is called liquid ratio. Now, this ratio has more than one name. It's called liquid ratio. So sometimes you see it as liquid ratio, or you can see it as quick ratio. That is another name, quick ratio. Or you can call it acid test ratio. So whichever one you see, we are referring to the same ratio. The quick ratio, liquid ratio, or acid test ratio. Now, this is why this ratio came about. There is a school of thought that thinks of something, and let us analyze that. Have you realized that we are saying that we have 2,000 current assets and we can pay off 1,006, and it's positive? So if they come on you right now, if your creditor should run to you right now that your debt is due, you have to pay, then it means that you know you have 2,000. But let us also take note of something. Have you also realized that another school of thought is saying that, have you realized that there is inventory in there? Inventory is not cash. We cannot use it to pay, and we are not dealing with barter trade here. Okay, so inventory has not been sold and it's there, but it's part of our current asset. So if today we want to look at our main liquid assets, very liquid asset that we can use to pay off when our creditors come on us today, we cannot pay with inventory. Receivables is acceptable because those ones are goods that we have sold and then people are owing. So when it comes that these people are taking legal actions against us, we can also take a legal action against our debtors, and then the court may order an offset or order them to pay or something. So we accept that yes, this one is liquid funds. Cash is already liquid and it's with us. So they are saying that, okay, if we really want to measure our liquid ratio, that is why we call it liquid, we should not include the inventory or the stock. Let us take out the stock and calculate this same ratio we calculated again. The current asset over the current liabilities is to 1. Now we are taking out stock and using the same formula to calculate, so that when we still have more than 1, let's say you have 1.1:1. When we included the inventory, had 1.25. So if we take out inventory and let's say you're having 1.1 or 1:1, then we know that we are at a strong position, because even after we have taken out inventory, we can still pay off all our short-term debts. Okay, so now it modifies this formula a little, and it's going to become current assets minus inventories all over current liabilities is to 1. So you see that nothing has really changed about this formula. The only thing is that we are taking out inventories. And if current assets minus inventories, then we can rewrite it this way, that in some books you will see that they will not say current assets over minus inventory. You can see it as receivables plus cash all over current liabilities, and it's the same thing. Is to 1. And so now whichever one you see, this is what we call the acid test ratio, or the liquid ratio, or the quick ratio. We are taking out inventories and then we are calculating to see whether we are in a strong position even when there is no inventory. So let us see, and that is what is going to inform our comments we make in the reports when we are doing the analysis and interpretation. Now let us take note of something. So let us try and calculate this and see with the same figures that we have here. So here the quick ratio is going to be, now it's not going to be, it will be 2,000 minus 600 over 1,600, and I think it's going to be $1,400 over 1,006. So you see that now the current asset is becoming smaller because we have taken out inventory. And the final answer is going to be 0.875 or 0.88 is to 1. So have you realized that when we took out the inventory, we are now having an asset representative which is less than 1? It means that truly, if they should all come, our liquid cash cannot settle them. Let us not deceive ourselves with the current ratio. However, because the inventory is also definitely going to be sold, and at a process we are still in a trade business, we don't completely say that, okay, once it is below 1, it means we are not doing well. So the idea is that once your liquid ratio is above 0.8, you take it to be okay, because eventually we are going to sell the inventory. And that is only acceptable when, if you add the inventory, you are going to go far beyond 1. That is why I told you that in as much as we do this second analysis, we don't ignore the original one, because we combine the two to make the analysis. If your current ratio is, let's say, 1.25 and your quick ratio is 0.8, it's okay, because once it's above 0.8, it's acceptable. Normally, if your quick ratio is below 0.8, that is where there is a problem. One other thing you should also take note is that if you are not doing the comparison for your own company in terms of year after year, but your comparison is with the industry, then you need to be mindful of the industry averages as well. If your industry is doing 0.95 over here and you are doing 0.88, you cannot tell me you are doing well when it's being compared to the industry. But if your industry is doing 0.7 and you are doing 0.88, then you are doing well. So some of these dynamics is based on the yardstick or the standard of performance that we have set, and that is going to be contained in our report. And so yes, this is the current ratio and this is the asset test ratio for the liquidity. Of course, if there is any other thing to talk about as far as liquidity is concerned, is the working capital. And the working capital is about just converting this ratio into absolute figures. And so the working capital itself is going to be current assets minus current liabilities. And that is very absolute. This is very absolute. So it's going to be $2,000 minus $1,600, which is going to give us a working capital of $400. This is very absolute. So normally you are not required to do that. So this is all about the liquidity ratios. Of course, there could be some others. Now, I told you that we are moving on to the activity ratios, where we are going to do the debtors collection period, inventory turnover period, and all. Those ones are efficiency, but they are related to liquidity. And so when we get there, I'm going to tell you how they are related to liquidity ratios. Okay, thank you for this. So this brings us to the end of part 1. In the part 2 of this video, which follows shortly, I'm going to continue with the ratios, and I'm going to talk about the efficiency and the activity ratios, as well as the gearing and the shareholder investment ratios. Remember to subscribe to the channel if you are yet to share this video and let others also have a benefit. We have a long way to go, because after the calculations, I'm going to take a question and then we are going to solve and learn how to comment on the videos. And then after that, we are going to learn how to write a report and then do proper analysis of financial statement. And so those who will be writing the professional exam from the level 1, 2, and even at the final level, you would be able to appreciate how to write the report in this lesson that I have started. God bless you. Until we meet again another time, it is bye for now.